Ken Shinoda joins us here in Studio 2, portfolio manager at DoubleLine Capital. And Ken, I want to focus first on the use of the word risk management, the phrase risk management, as a way to characterize what happened today. What do you think he meant by that?
Yes, I was really keen on that word because the bulls were hoping for more dovish language out of him. The bears, maybe those who wanted to short bonds, were hoping for some hawkish rhetoric. And I think he picked that risk management word because it was, this is a cut, but we don't know what's going to come as far as the data, and we need to go meeting by meeting and be data dependent. So he's keeping that data-dependent way that the Fed has been acting.
Are you surprised by that?
I think that he does not want to make the mistakes that other Fed chairmen have made in the past by cutting too soon, and so he's really keen on keeping rates where they are, staying restrictive until he's really sure that the inflation is contained. But he's definitely concerned about the labor market. We've had some weaker non-farm payrolls, and that's what he was focusing on in that at the end there.
Well, in your role, in the money you manage, and more particularly the types of assets you manage, what's more of a concern for you right now, the labor market or inflation?
For credit-sensitive assets, then we're really focused on the labor market if we're heading into a recession. But company earnings are strong, retail sales came in decent, and so the credit markets aren't really worried about it now. I think I'm more concerned about the long end of the yield curve. It's had a decent rally here, but if we go back to concerns around too much fiscal stimulus, excess spending by the government, I think that long end could steepen more. So I'm more convinced that if things weaken, the 2-year will fall in yield, then I'm convinced that the long bond will have a huge rally.
What is that balance right now? Because, I mean, he didn't talk a whole lot about that and really wasn't asked about it, to be fair. But there has been this positioning in the market that has pretty much been short duration or at least medium-term duration, and not a whole lot going on the long end of the curve other than for those institutions that basically have a mandate to buy out there.
Well, it's been a good place to be. T-bill rates have been really high. The 2-year was a few weeks ago closer to 4%. You could buy some credit assets on the front of the curve. So look, I still like that front end of the curve. We've had a little bit of a rally here that maybe we could see a pullback. I hate to read too much into price action on Fed Day because there's so many people that are changing the positioning. But I think if you get a little bit of a pullback across the curve, it's good time to add. You don't need to add the long bond, but I feel like a broken record. I've been on here for the last couple of years saying that like kind of 2 to 5 year portion of the curve, it's a good place to be.
I am curious what the net effect. Let's assume for a second this is the start of an actual rate cutting cycle and not just a one-off. I mean, they've promised, or at least the dot plot promises, 2 more cuts this year, maybe 1 in 2026. With regards to the housing market, we saw housing stocks today get a little bit of a boost. Some bank stocks also getting a bit of a boost. For mortgage traders, mortgage bond traders here, is that going to be a net positive, or is this something now that you have to kind of hedge?
Cutting rates is definitely net positive for investors that buy agency mortgage-backed securities. The spread that you get paid is highly correlated with interest rate volatility. So when bond prices are going down, rate volatility is going up. That's a really bad market for agency MBS, and we saw that through kind of like 2021 on through the middle of 2023. But as they cut rates and rate volatility comes down, that's a really good market for government-guaranteed agency mortgage-backed securities. You mentioned the housing market. The challenge the housing market has is, let's just say the neutral rate is 3, and the Fed cuts all the way to that through the end of next year. Will the 10-year, the mortgage rates that you as a borrower get out there in America, it's really tied off the 10-year portion of the curve. Are we really going to see lower 10-year Treasury yields than 4%? I think you might need to see a recession or a big slowdown in growth to really break down and get down towards that kind of mid-3s.
Are you anticipating that we will see, I guess, if not in a recession, more economic pain in the short run or medium run?
It's hard to say. We're all watching the data. One of the things that we're noodling on, and Jerome mentioned that he's looking at the payroll numbers because they used to come in.
You're on a first-name basis with him?
I hope so.
Okay.
I feel like he's a nice guy. Payroll numbers have been coming in, 100 to 150,000, and now they're coming in, and I think Powell referenced kind of that 0 to 50,000 range, and so people are concerned. Now, things have changed. We've seen a big demographic shift. Baby boomers leaving the workforce. Immigration's down a lot. So maybe a lower non-farm payrolls number, maybe that's the new normal, right? And so really, we should be more keen on the unemployment number as opposed to just focusing on job creation.
Is 3% inflation the new normal as well? Because we've basically been camped out there, at least on the PCE core.
Yeah, we're there right now. Goods inflation came up a little bit, and and he even mentioned that he's watching that. But it seems like so far companies have been eating a lot of that inflation and not passing it through. And if I don't think if we see it in the next couple of months, I think that tariff inflation isn't going to be as bad as people thought.
Yeah, that seemed to be a big takeaway, and he even addressed that during the press conference. The idea that a lot of that is sort of getting sucked out by the middlemen, and at least for right now, that's good for the economy. Ken, I have to leave it there. Always a pleasure.
All right, thank you.